that path to stagflation, which is the combination of inflation and low growth, is becoming more so a reality than ever.
Hello and welcome to Wealthion. I'm Maggie Lake, and today I'm joined by Diego Parrilla, the CIO of Quadriga Asset Managers, author of The Energy World is Flat and Anti-Bubbles, and visiting lecturer at Imperial College in London. Hi, Diego. It's great to have you on.
Thank you, Maggie. Thanks for having me.
So, as we can tell from that intro, you have been thinking and writing about market and debt bubbles and sort of these big macro dynamics for a long time. So, I'm really curious, how would you describe what's unfolding in global markets right now?
I mean, we're clearly, I think I would break it down in two parts. First one is, from a structural perspective, the damage had already been done in some ways. We've seen decades of monetary and fiscal abuse that have led to imbalances in the system. The monetary and fiscal policies without limits do not solve problems; they just delay, transfer, transform, and enlarge them. And so, the starting point, is complex, and we've had a lot of other dynamics in play, including geopolitical issues as well as AI, and so a very complex dynamic. But what we're witnessing now with this new era of Trumponomics, and the tariffs, I described it a bit like a perfect storm for hostile markets, because you're really hitting in some of the weakest areas. You're creating a lot of uncertainty around investments and around outlook. This is just bad news. You're creating clear inflationary pressures, which is the Achilles heels of global financial markets, as they can impact. Through high inflation, you could have effectively a scenario of lower equities and lower fixed income, and I think that's a big problem. You have obviously higher volatility, which we're experiencing, and that's also damaging for risk, and lower economic growth as a result of these measures. So I think in some ways what we're experiencing is can be a game changer. Certainly, Mr. Trump is positioning this as a historic moment. Liberation Day was to be talked about in decades to come, and certainly a belief in something that he generally thinks is the right thing to do, and the price that will pay is worth it. Having said that, I think, like great philosopher Mike Tyson would say, everyone has a plan until they punch you in the face. And I think the markets are starting to test a little bit of that view, not just on the equity markets, which I think some of the valuations were perhaps stretched, but I think also on the fixed income markets, which I think poses a bigger challenge, and that's already creating some strain. So as of speaking right now, we just had all this rhetoric with Powell, and he can't wait to get him out. And so I think the pressure, the tension is growing across multiple fronts, and volatility is going to remain high. Uncertainty, I think, will remain high. And I think he's got himself into such a mess that you can't just pretend. You can just walk back from this. So I think we're in a fragile situation that is exposing a lot of the pre-existing fragility of the system. And it's going to be a rocky ride.
It's interesting that you talk about the pre-existing fragilities, because if you follow the headlines, this is trade. This is an attempt to rebalance global trade, which a lot of people acknowledge maybe needed to happen. But when you're talking about those existing fragilities, what exactly is the root of the problem? Because it sounds like we were heading there anyway. Maybe this is just created more volatility around this, but the rubber was going to hit the road. What is the root? What is the root of that fragility that we need to understand? Because that seems really important.
Yeah, I think, look, when I wrote the anti-bubbles in 2017, that was in the midst of negative nominal interest rates, which was kind of taking monetary policies without limits to an extreme we've never seen before, right? I mean, it's an absurdity to have nominal interest rates, and that abuse of monetary policies has always gone hand in hand with fiscal abuse. In some ways, the ability for governments to overextend their debt was rewarded and encouraged and facilitated by a world of artificial low interest rates where central banks were literally printing money and lending it out.
Mm.
So the levels of debt that we've taken at a global scale are just simply artificial. You can't possibly think that you can sustain some of those levels of debt without the support from I guess money printing in one way or another. And so I think this dynamics that we lived through for the last few decades, acknowledging that or pretending that deflation was the enemy, that we just couldn't print enough, and that we had to effectively overextend ourselves. And I think this has created a situation that is effectively limiting the ability of economies and the world to continue to play the same game. And
Mm.
so the dynamics that we've seen with AI, and which is clearly a game changer, have in some ways created this phenomenal valuations. We've seen a lot of things come into play the last few years with the pandemic and again, a technological game changer, and other things that have created this perception of invincibility. And in some ways, I think the monetary and fiscal abuse that we've seen it was simply unsustainable. It was a matter of time that things would have to go in check. And in some ways, if you were to write a movie, I don't think you could come up with a better script than coming up with this sort of dynamic of tariffs. That, as I said earlier, it's a deathly combination of what hurts most, which is inflation, volatility, uncertainty,
Mm.
and lower economic growth. So as we go into this, there's big questions being asked, that are multi-decade. People starting to challenge the role of treasuries or the dollar. Are they really safe havens, or are we in a new paradigm? And things like gold, which are performing incredibly, which is in my view long overdue. I mean, the subtitle of my book was called "Gold's Perfect Storm." It was very obvious that all this monetary and fiscal abuse would result in some of these things. And yeah, as we head into this, from a game theory perspective, I've always believed that the system is designed to finish in stagflation. Faced with these challenges, or governments and central banks are always going to do the same thing. They're going to print and borrow. And so I think that addiction to monetary and fiscal policies without limits eventually has limits, and things. This is not a zero-sum game. It creates second, third order effects, but ultimately I think that path to stagflation, which is the combination of inflation and low growth, is becoming more so a reality than ever. So yeah, I think
I think
this
it's
is
really
something that
important. I think
have
it's really
within.
important to lay
Sorry.
that out. I'm just going to jump in here because I feel like, and we'll unpack all of what you just said, but I think it's really important to point that out because I think, as you just explained it, a lot of people can wrap their head around that because it's sort of raging around with a credit card and no one ever charging you interest and feeling like there was this amazing power with that, and then the sort of bill coming home to roost and all of the difficulties of getting out under that. If anyone's ever experienced that, I think people can relate to that and can kind of make sense of that, even though it's on this massive level. So I think it's really important to sort of set that as the root of the problem. So from if I'm hearing you correctly, that there is a sense, and I'm presuming people certainly within the Trump administration know this because, Scott Bessent was a macro hedge fund manager. I mean, I'm sure he read your book. I mean, and I'm sure you've all had conversations with each other over the years because this isn't a new concept. And many of you have been warning about this for a long time. Can this be fixed by resetting global trade? I know right now, the moment we're in, there's uncertainty, there's volatility, there's concerns about inflation. But ultimately, if they are successful in renegotiating this global free trade with more nations involved, and somehow this whole tariff war ends with less tariffs, is that a step in the right direction? Can resetting global trade, if they were successful, start to address some of that debt level, or is that the wrong remedy?
No, big questions. I think clearly the trend of globalization versus arguably the bipolarization of the world, or the protectionism of America first. I think these are beliefs. These are major issues that you can find scapegoats for, to blame whoever you want for the issues, but I sincerely believe that what Trump is trying to do is, it's not just about the countries. I think the message is addressed to the corporates themselves. Ultimately, if you're Apple and you're building in China, nobody arguably put a gun in your head to do that. They may have given you benefits and incentives and a lot of carrots, but ultimately the decision is yours. He generally feels that this is something that needs to be restored, and I think there are a lot of challenges in this process because the damage is clearly there. I think it's totally unrealistic that you can just switch on and off and pretend that corporates can just overnight be able to continue their operations. There's going to be a lot of disruptions. Clearly going to be disruptive with inflation and growth, and that's impacting valuations. And we're in a world where there's this big battle, between deflationary forces and inflationary forces. And we heard Powell speaking, and so I think whilst the direction might be correct in the sense that maybe it's the right thing, and there's been some imbalances and some arguably abuses in the system that have led to things that might need to be corrected. The way in which it's been handled and the aggressiveness and speediness of the moves is certainly very damaging. And I think as we look through, we're talking about inflation, but what really matters even more than inflation itself is inflation expectations. And that's something that in a world of low inflation, central banks are in control. We are. I always said that we're frogs in a monetary broth. Where the temperature is increasing at an official rate of 2% per annum, which is complete BS, to be honest. But the game is really about us frogs staying in that broth. And what's the reason why us frogs would jump out of that, let's call it fixed income broth, that world where you think you're okay? And it's obviously high jumps in inflation, but it's mostly inflation expectations.
Mm.
And that is the reason why back in 22 we had this phenomenal move in hikes and rates. It wasn't really inflation itself. We have had inflation for a long time. It was inflation expectations getting out of control, and I think that demon is coming out of the bottle again, and it's coming in the middle of other hostilities and wars. And I think that pressure that is going to put on governments' finances and all the other points we've made means that the timing and the sequence of these problems to solve is, bringing the usual short-term, long-term dynamics. And so arguably, even if some of these measures might be the right thing in the long term, I think the path's going to be extraordinarily painful, and I wonder if it's going to be even something they can handle if it goes. So that kind of forces, some sort of negotiations, as you say. But I think about it in a way that, look, would you go if Trump, needs to save face? He's put us all into this big mess. He has clearly decided that he can't just back off. So he's picked on China as being the bad guy, and both sides are, might try to negotiate. I think it would be hard, I think, given the beliefs and the lack of trust, particularly on the U.S. side, on
Mm.
because some agreements were reached before, and according to the administration, they feel that they weren't honored, and it's been just, there are deeper things that you can read and directly between the lines, but also explicitly. And so I think the U.S.-China thing is going to be very difficult to resolve. And if you think about it, and you suddenly you come up with an agreement with let's say Vietnam or or anybody else, at the end of the day, Trump wants all those things brought back to the U.S. Right? He wants the money, the jobs, the technology, the, uh, the production capacity. He wants that back. So how is he going to come up with agreements with third parties like Vietnam if that's just transferring the problem from China to Vietnam or whatever else? So I think he's really trapped. I think it's going to be very difficult to do something meaningful enough. But ultimately, whatever compromise they do, and if this is done in a very small scale, it's going to take time. There are multilateral negotiations. Um, Time's really going against him in the sense that even the delays, which sorry. So basically, in that sense, the all these dynamics that are taking place in terms of the these pressures, I think, are really hurting him. And uncertainty, I think, is a major factor. I mean, you've seen the ECB cutting today, and arguably going for another three cuts, and uncertainty is everywhere. And that's a real thing. So these negotiations are really, again, might be the right idea, but the cost is high. The mismatches in timing are going to put a lot of stress into a lot of areas, and this is already happening in a world of where we have limited room to maneuver in terms of fiscal expansions. And so I think it's a bit of a mess. I mean, you can see how all these pieces are coming together to reinforce this idea of volatility and uncertainty and lower growth. Can we completely unwind it? I don't think so. I think it would be, it would require something pretty major. So I think Trump's going to have to save face, and just, I think ultimately it's a matter of belief. So I think he will continue on this line, and even if he throws lines and bones and compromises, I think deep inside, and the deep-rooted problem is, he wants to bring that back to the U.S., not to Vietnam or Japan or whatever. So it's going to be very interesting. And in the meantime, I think we should be ready for more wild headlines and pressure building in the system. So from a market's perspective, is arguably a bit worrying, but I think volatility will continue to rule, and inflation is, it's like the entropy of the universe. It just only goes up. So I think in that sense, the market's already telling you there are worries about that, and you can see how governments are reacting to that, and how the forces are pulling in both directions. So I think it's a recipe for a lot of volatility and uncertainty, and this is never good news for markets.
No, and we can feel that. I think all of us can feel that. So this is inflationary in your mind. We're in an inflationary period because, as you know, there are plenty of people who are saying deflation's everywhere. This is why central banks have to move. We're seeing prices fall. I guess on the back of this idea that people are, because of the uncertainty, pulling back, and that we're headed for a global recession, or at the very least a US recession, and that'll kill demand. Why do you think this is an inflationary period? What are you seeing that the deflationary camp doesn't?
No, I think there's two forces. Of course, there's a lot of deflationary pressures, and there's also inflationary pressures. And it depends which side you're on. I think the real issue with inflation is monetary inflation, is structural inflation that comes through money printing and debt. The cyclical inflation is what it is. You have strong cycles and weak cycles, and super cycles in commodity markets, with super high prices, and there's a lag for investment. All those, let's call it cyclical and super cyclical inflationary pressures, are rules are within the game. The reason I think this is ultimately inflationary is because of the wrong type of inflation, which is the monetary inflation.
Mm.
And that's just pure money printing and debt that is the system is taking. And that's very much one way. And the bigger the problem, the more you need it. There's no doubt in my mind that, if you look at, I don't think it's a coincidence that Trump sort of gave this relief to markets last week, as the 10-year bond was at 4.5, and the 30-year bond was at 5, and these levels make extraordinarily difficult to finance yourself and refinance yourself. And I think if these things be out of control, then they bring what is inevitable, in my view, which is yield curve control. Yield curve control is a mechanism by which, it's basically the next level of QE, right? QE at the end of the day was, we're going to print 500 billion a month, and we're going to buy stuff, right? This is, I'm just going to buy infinite amount to make sure the yields don't go, right?
Mm.
And we've seen this in action. We've seen it in Japan, and we know what it means for the currency and inflation. So I think in a world where the level of debt is too high, and you basically been tested on that through higher yields, I think there's no question that we're going to see basically more printing. So that's a reason why inflation is, in my view, structural, and why in a way the more deflation you have in the system, and in terms of lower economic activity, the more inflation you're going to get through the other channel. And we have plenty of examples in Latin America and many other places of how these monetary and fiscal policies end up in effectively diluting the value of the currency, creating structural inflation, and creating the stagflationary problems that I'm talking about. I think you can easily get fooled by the deflationary pressures of the economic activity and things which are real, but the problem is so large that you're just not going to go through the real pain you should endure. You're just going to go and do it all again and just print more and sustain the system and find ways and great acronyms. We seem to be pretty good at that will effectively create mechanisms by which these things get stabilized. But let's not fool ourselves. This is just, they're not solving the problem. They're delaying, transferring, transforming, and enlarging the problems, which is, again, reinforcing the thesis of the anti-bubbles that I put forth in the book.
So I think that's such an important explanation. And you're the second person to sort of hint at that this week with me. And I think it's really, really helps us understand why things seem so confusing and at odds when you're talking about that. Sort of those high street, main street price increases being very different, or price decreases being very different from that structural inflation, and the inflation expectation that you're concerned about, that stagflationary kind of spiral, is because of that monetary inflation, not because of the prices we pay at the food store or something else. So what do investors need to understand when it comes to investing in this kind of environment?
Well, in my view, if you think about portfolio construction and building your objectives, I think we're in a new game, right? I think inflation is you can't ignore it. I mean, for the longest time, we've been working on you could pretty much ignore inflation from your investment decisions, and it's only a relatively recent event, and even today, I don't think people are that cautious or in terms of what it means. But I think the big dynamic that is challenging in many ways the setup is what does inflation mean for fixed income and credit markets. In some ways, you're earning your high nominal returns, and I would argue that if you look at the U.S. fixed income market, with 10-year yields at roughly 4.3% as we speak, we've sort of earned a lot of defensive power. The duration, with very simple back of the envelope maths, if there was a crisis and interest rates were sent all the way back to zero, you could gain potentially, this 43%, arguably in capital gains, just through the PV of the coupon. So, in some ways, these high yields give you the potential for defense, which is something again we earned through the hikes. At the same time, it's questionable whether in a world where inflation is sticky and structural, whether you can actually do that, or to what extent, is zero realistic, or are we looking at 2% or 4%, or what happens if you can't really come to the rescue with fixed income. And I think that reality where the 60-40 balance portfolio faces those inflationary pressures and challenges, I think it creates risks, the risk of false diversification. We saw it in 2022, and we've seen a little bit of that in the past few weeks. And I think this is something that the inflation expectations, the realization that this is not just about nominal returns, but real returns and the purchase of power in the long term, I think it's something that, again, has deep implications. What it means is that when you think about diversification, you probably need more reliable sources of uncorrelation, or things that will protect your portfolio, and that's kind of what I've been doing, for forever. I mean, if your portfolio was a football team, we play goalkeeper, and I think that role of goalkeeper becomes ever more relevant when the defenders, such as fixed income, start to fail, or they're not able to do their job. So yeah, I think in terms of investments, we are, perhaps conditioned to believe that the spikes in volatility are very short-lived, that everything will go back to a very low, let's say, VIX below 15 of environment. You buy the dip, you sell the spikes on the VIX, you sit on these things that always go up. And I just don't think those free puts are there. It's going to be a much more volatile environment with this additional risks of inflation and geopolitics and uncertainty. And so in some ways, I think it's the game is a lot more open than it's been in a very, very long time. And you could get people in this show that will call for the next move being down 40%, and some people will call it for up 40%. And that, I don't think either one of us is right. I think what it's telling you is going to be very volatile, and that's clear. But the longer this continues, or if the situation doesn't improve, I think the pressure builds up for lower, and that's kind of my base case. I think things remain volatile. Things start to weigh on the system. There's a lot of uncertainty, and that impacts consumption, investments, and before you know it, you need to get this additional support. But in some ways, it's going to be challenged by arguably a lot of these inflationary pressures that are coming also from the tariffs themselves and other issues. So I think volatility rules, and that creates, again, without this idea of buy the dip, and being correlations and dispersion increasing. And let's not forget, we're probably seeing the burst of the AI bubble, at least in its first wave. I think clearly is a game changer as a technology. We've seen this movie before. My book, The Energy World is Flat, was inspired by Friedman's book, The World is Flat, which was a post-mortem of the dot-com. And I think there's a lot of lessons to be learned from the dot-com, with a game changer technology, the big investments done, the overcapacity, the write-offs, and how ultimately the big winners were the consumers, were the different people, not necessarily those huge corporates that were expected to make those huge gains. So I think there's a lot of factors coming in, But certainly the market dynamics, whether we're talking about individual investments or outlook or volatility or interest rates or growth expectations or investments or anything else, or or portfolio construction, is way more uncertain and way more volatile than it's been, and that I think it's going to impact also risk taking and other things, which kind of
Mm.
everything pushes back to the point we're making. That it's a bit of a fragile environment, and that doesn't have a pretty obvious solution.
Yeah. So I'm curious, Diego, you wrote these books. I mean, 2017. You've been thinking about this for a long time. How does it feel now that it's actually playing out? I mean, this is kind of what you predicted.
Now, look, both books. I think if you read them at the time, they're like, "What the hell? What is this guy talking about?" Today's, of
Yeah.
course. Um, I think when you have this, the first thing I would say is that writing these books is very humbling exercise. It's an exercise of as Cicero would say, if you want to learn and teach, or if you want to learn write. I found those books as an exercise for me to try to make sense of incredible things. The Anti-Bubbles was really about, what are we doing with this thing of negative nominal yields? Is it really as simple as that? Can we
Mm.
are we really solving problems? What exactly is it? And so I think when you have these very long-term models in your head that are 10,000 feet or higher, then yeah, it's basically you get away from all the short-term noise and a lot of things. And I'm sort of blessed or lucky that the themes that I presented both in both books and in general, um, I haven't just survived the passage of time; they've actually been reinforced. And
Mm.
to be honest, this it's also, if you're a student of history, then you realize that this what we're doing is nothing new under the sun in some way. So a lot of the things we're doing and have been trying, I think we might think this time is different, but ultimately, from a macro perspective, again, there are a lot of bright minds that share my concerns. And when I dedicate my book, I've always said, I hope you like it. I hope I'm wrong, because
Right, well, that's why I'm asking because I know I mean, no one was accusing you of being Chicken Little, the sky is falling, but there was an element of that for those of you who have been looking at this and kind of warning of this, and when that happens, there is a point where you're like, "Well, okay, the sky is falling, but shit, the sky is falling, like, this is not good," you know? So, that's why I was curious about how it feels. It's almost kind of the worst case scenario, what you all try to warn people against is now unfolding. So you must have thought about how to navigate through that, in the worst case scenario that you turned out
yeah,
it
I
turned out
feel
to be what you
I
thought.
feel like a doctor diagnosing a bad disease to a friend. I as a doctor, you want to be correct. As a friend, you want to be wrong. I think some of the things we're seeing, um, are, again, from a game theory perspective, the game is designed in a way that it will end up in stagflation. It's just, from my perspective, it's how it works. If you are a government and you want to win the next election, and you can actually borrow a lot, and that you can do because you control the central bank, who's basically printing money to lend you and allow you to do things that wouldn't be possible, and that leads you to levels of debt that are unsustainable, and means that you're creating systemic risk, which means that mommy and daddy need to come back to the rescue again, and that sort of saves the day and creates the next wave and a new paradigm. This thing just the snowball keeps going. And yeah, I think ultimately the sky may fall, but the sun will come out. There'll be transfers. We've seen countries in like Latin America and others that I think we should study and pay close attention to what it means for those economies when you go that route. And yeah, I think people like Ray Dalio or myself are worried about geopolitical implications and what it means. And that's what truly worries me. And that direction of autocracy and geopolitics and inflation and scapegoats is happening. And it's, I think, for the average people, it's very hard to pinpoint exactly who to blame, right? And it's very easy to manipulate that. But ultimately, some of arguably well-intended solutions to problems, such as, you could go back to you know 2008, right, and how we decided to address certain issues. I think I think in Spanish we have there's an expression. It's just "Cuando se jodió el Perú?" They say, "When did Peru screw it up?" And it's a very well-known sentence, and people discuss, go back in history, like, okay, where did it all start? Where did we go wrong? And I think you can go back and see that some of these things arguably were, again, short-term, long-term trade-offs, but it's always one way. Faced with systemic risk, or faced with a pandemic, or faced with a war, or faced with a crisis of the financial system, or regional banks, or an energy crisis, every single time we do the same. Every single time we solve it through a combination of money printing and debt. And the point I'm making is we're not really solving the problem. We are delaying, transferring, transforming, and enlarging the problem. And so you may have averted a regional banking crisis or a European energy crisis, but you ended up transforming the problem into inflation and inequality and social unrest. And that's why this is how things work at the macro space, and why some of my big picture macro frameworks are working, and they're playing out. And it's not a crystal ball. It's just understanding some of those dynamics and how they compound. And I think ultimately we've passed the point of no return, unfortunately, a long time ago in some of these economies, and you see this thing accelerating. I think that new phase ahead of us is yield curve control. That's going to be the new acronym. They may call it yield curve control. They may call it something else. In Japan, it's called yield curve control. They used it, and they shied away from it, and it's put aside, but certainly will come back. Have 100%, 99.9% certainty that I think it will be needed again. In Europe, the day we did the first jumbo hike from minus 0.75 to zero, I mean, it's kind of science fiction to that we were ever at those levels. But the day they did that, they introduced the anti-fragmentation tool, which was, okay, guys, we're going to hike rates, but please don't mess around with Spain and Italy, because we're not going to let it happen. And if you think about it, it's pretty remarkable that on the way up of yields, actually the periphery was very well behaved. It was very well behaved because the ECB was ready to step in and introduce yield curve control. And I think the Fed, if things get bad, will have to do something similar. And this is, de facto everywhere in the world. Everyone has the same disease. And I think that's what's coming on the macro, which accelerates currency devaluations, inflation, and it brings us to the reality of a world where you can no longer ignore inflation, and the frogs start to jump, and central banks lose control, and fixed income again requires this printing, which is a self-reinforcing mechanism. Why gold might be on its way to 10K and real assets, and so how do you stop that? It takes austerity, it takes pain, it takes things that politically are very difficult to handle. And so whilst we're well intended and we try to impose those, I think realistically they're always tricky. But look, Argentina perhaps shows a bit of a glimpse of hope in terms of how what was a country already deep into the abyss is taking some very dramatic measures. But I think the beauty of Argentina in some ways is how the populist community has finally understood that all those measures were really counterproductive, and how I think
Mm,
if they really want to get, uh, you know, want to avoid these issues, some pain is to come. But yeah, so hopefully, I think we'll find that path. But certainly, the current road and the new dynamics are, in my view, not necessarily going in that direction. They're going in the opposite direction, because we're going to these artificial measures and things that we're introducing in the system. Um, I don't think they're helping for that path. But who knows? Maybe that's the catalyst that we need to get things on the right track. But it's not easy. I mean, we've seen it with the Draghi report, and in general, people know what we need to do. It's really hard to get it done, and
right.
in these circumstances, with this polarization of the world, it's becoming even harder. So yeah, it's
It's
a
much
very
easier to
fascinating picture
blame.
from a macro perspective. We with forces
Yeah.
in every dimension and direction.
I mean, yeah, we need problem solvers, it seems more than ever. In this environment, what does the anti-bubble strategy suggest in terms of investment? Are there any safe havens? You mentioned gold. Is that the only safe haven?
Well, the idea of the bubble anti-bubble, for those who are not familiar with it, is, bubbles are, if I borrow George Soros' definition of bubble, is assets that are artificially expensive based on a belief that happens to be false, what he calls a misconception. So, for example, if you look at NVIDIA and the day that the DeepSeek announcement came out, there were a bunch of misconceptions, a lot of pillars that were sustaining those valuations that were hit. Like, you need these supercomputers. No, turns out you can do it with your children's a gaming computer. Oh, I'm the only game in town. Margins are infinite, demand is infinite. As you get these misconceptions hit, effectively some of these bubbles implode. So what I did with the concept of anti-bubble is I generalized the framework, and I said, okay, misconceptions can distort reality, but not only through artificially high valuations, also through artificially low valuations. And if you think about the typical bubble anti-bubble relationship, like in equity versus VIX, there's no good guy and bad guy in the bubble anti-bubble movie. Sometimes equities are artificially expensive and volatility is artificially cheap, and sometimes during crisis is the other way around. Volatility is artificially high and equities are artificially low. So my view is, this is a game where you need to embrace volatility. You shouldn't fight it.
Mm,
You need to be in a position where you have both equities and reliable reactive protection. And I don't think fixed income is that reliable reactive protection. We run strategies that run basically volatility and tail risk. And so your direct, reliable reactive protection for an S&P long would be an S&P put. Okay, so that's going to give you, but those type of protections can be expensive, can have a lot of negative risk premia. So there are other ways in which you could try to protect, whether it's VIX call options or gold, or arguably the dollar or duration, or others. I think in this environment, as we discussed earlier, some of those called safe havens are being challenged. We are now in a situation where one of the biggest questions out there is the dollar safe haven currencies? Is are Treasury safe haven, or are they the problem, or are they potentially going to come and save me? And I think this is really a big question. Um, I still think that what we're witnessing today as a narrative, narratives are very powerful and they tend to move markets, and so very often you get overextended. Um, Look, for the time being, when seeing, I'm a contrarian guy, and in that sense, I think whilst the dollar and treasuries are, on the spotlight today, I still think the euro or the yen or the yuan are no way better. You have interest rate differentials that are widening. You have a positioning that is becoming pretty much one way, and ultimately a lot of other dynamics that could lead to if you had these big shocks. So I think our approach is really about creating strategies that combine like a long only equity with the protection. And what we do is we just embrace that volatility. We try to accumulate and monetize the protection, and
Mhm.
just embrace that volatility of the market. If you are levered long only, you're fighting volatility, you're short volatility. When volatility spikes, people tend to lose, and if you're over levered, you might be wiped out. I think this is an environment where you have to find portfolios that are truly diversified, and I'm not talking about average correlations, which is a very common mistake. I'm talking about correlations on the extremes. How do you behave under these 2 3 sigma events? And so that's really what we do. We run a couple of strategies that try to do this. One as a pure goalkeeper, the other one as a combination. People who follow me may see some updates on LinkedIn or X Twitter. But I think this is an environment where you can't ignore inflation. You have to embrace volatility, and you need to look for portfolios that will effectively benefit from that without leverage, and in ways you can actually take advantage of these dynamics. And as I said, there's no good guy and bad guy in the movie. I think the strikers and equities have a role to play. The defenders, volatility and tail risk and gold, and arguably we'll see where the dollar and treasuries land. But I think they're going to be also quite volatile themselves. But I lean for the view that they're still defenders, and this narrative can actually get you really good entry point to accumulate some of that. But having said that, the reality is very fluid, and we need to keep very adaptable to what's happening, and things are happening very fast. So yeah, I think from a portfolio investment perspective, that would be my advice. I mean, beware of inflation. I think is way stickier. That has deep implications, and embrace volatility. And to do that, make sure that the diversification of the portfolio is real. And to do that, you need stuff that will be designed to perform in a given way, which is sort of what we do on a day-to-day basis and what I've specialized on.
Yeah. I always love your football for American soccer analogy because I think it really helps put that into perspective. And I love the idea that there's no good guy, bad guy, because a lot of people get married to narrative here and sort of demonize certain asset classes or geographies, or let's face it, in this hyper political environment, administrations as well, and sort of feed that into their investment narrative, which can get, I think, sort of muddy the water. You mentioned, uh, I think, gold at 10K. Is this kind of even though there's no good guy, bad guy, and you have to have a variety and true diversification, is this kind of a golden era for hard assets given all the uncertainty?
Yeah, I think, look, gold is unique. I'm not just making it up. It's been doing a job for over 2,500 years, right? And it has these pretty unique features, physical and chemical, and monetary. Look, in the book with gold, roughly around 1,000, 1,200, or whatever it was. I always said, gold has a few $100s of downside. It has a few $1,000s of upside. Uh, what I'm going to say now sounds pretty simple, but basically, when you go from 1,000 to $3,000 an ounce, you earned 200% return. If the next $2,000 from 3,000 to 5,000 is only a 66% return, okay? In order to do that 200% move, you're going to go from 3 to 9K. So I think in some ways, the exponential nature of some of these assets in a world of exponential monetary growth, and as you get into yield curve control, we're in a new territory. It's totally uncharted. Um, it's not just a number, because obviously you have many dynamics. I mean, gold is also used for industrial uses, and there's mining, and there's scrap, and there's hundreds of things. But in some ways, the merit of gold and real assets in general is not their own; is the demerit of the
Everything
units,
else.
is the currency. So we talk about gold in dollars or euros, but for example, in Swiss franc. I mean, I think this month to date, everyone's looking at gold as the star. No, the star of the month is the Swiss franc. It's up 8.5% this month versus the dollar, with gold 7 as we speak. Now that move is incredible. Okay, and I think it makes me think a little bit that it's not a coincidence that these huge moves that we're seeing are happening pretty much for the low yielding currencies, which is the currencies that are generally used for carry trades. So this pickup in volatility and this big uncertainty is resulting in a mega unwind of carry trades, because at the end of the day, long dollar Swiss or dollar yen or dollar euro, it's a very positive carry trade. I mean, as we speak, you're earning 2, 3, 4% per year, being long arguably what is a safe haven asset, right? So I think in that sense, the accumulation of some of these positions in the system through trend following and macro and others is huge, because it made so much sense, right? Now, the pain that we've seen through the unwind of those positions, I think the jury's out whether how much of that is really just the unwind of some of these carry trades, which, by the way, we see every single crisis. So the first thing you see or you saw in March 2020 as volatility picked up was the unwind of carry trades. It's not like the yen was the best thing in the world, and the yen rallied and the Aussie dollar collapsed because people were unwinding Aussie yen trades, right? So I think in some ways the weakness of the dollar might look a bit strange because you don't associate the dollar with a carry trade. You normally associate, EM currencies like the Turkish lira or to some extent the higher yielders. But I think it's a very interesting dynamic. The magnitude of the moves is pretty brutal. But you look at dollar CNH, like the Chinese yuan or others, and that's been arguably very muted. And I think the fundamentals, are obviously divergent for many of these. But I think the gold story is real. Gold, has potentially again a long way to go. The narrative is becoming very strong. Warning: it's a crowded trade, and it's going to be. I think there's safe hands behind the moving gold. I think you could probably argue that there's been central banks accumulating and to some extent maybe even dumping treasuries in favor of gold. That's again a big flow. But if you think about the positioning, and if people were thinking, oh my god, I lost the gold train, I'll buy the silver train, this month you saw a drawdown of almost 15% in the first leg. So I think the market was really exposing a lot of the positioning, and I think fundamentals, for things like silver, could be very bright, but you can see that a lot of these price moves are not just fundamentals. There's really a lot of positioning, and I think gold, it's still under owned, but it's also becoming crowded, and so I think whilst the long term picture is, I think, very constructive, beware of highly leveraged positions because they can really take you out. So I think in some ways, as always, leverage is your enemy, and I think gold is very well positioned for these big moves. But just it's in this volatility and shocks and moves, anything can happen. So I'm a big believer. Is a meaningful part of our portfolio and our strategies is core, but yeah, we do it in ways that we think makes sense. We can hold and we can benefit for the long term. This is not a 2 week trade. This is multi-year trade, and I think that that trade is very, very likely going to perform again, partially because of the merits of gold, partially because of the demerits of everybody else.
Yeah, the demerits, I love that. Does Bitcoin have a role in your anti-bubble strategy?
I think Bitcoin's fascinating. It's remarkable how stable it's been in the last few weeks. Um, I I've written a lot about this. I'm asked a lot about it. I think there's a lot of merits from the technology. Uh, we need solutions to the problem of money, etc. Personally, I don't own any. Personally, don't take it personal. I don't really believe in. I think that in the civil war between different cryptos, I think I'm the kind of guy who tries to fall in love with the problem, not the solution. And I think for example, all the stuff that came out with Trump and the Trump coin and the Melania coin, this is really so blatant that is so obvious that these things are worth zero. It's not. It's not. You don't even need a PhD. I mean, you don't need too much. Uh, I think common sense to know that you're using alchemy to just create value out of nothing. It creates this wealth effect where people feel very rich based on some spurious, completely, things that are completely out of thin air. So, and you can actually create these things ad infinitum. And arguably, as humans, we love alchemy. Many of the previous crises, like 2008, uh, you know, securitization crisis was, we thought we could take 100 pieces of garbage and come up with a bunch of gold. In that case, were mortgages. I think there's a lot of alchemy in the system, and ultimately, I think there's some merit, but I think there's a lot of risk as well, and so you know we'll see. As I say, I'm not I don't own it. Whoever does it, I think they should do without leverage. And again, I think Bitcoin's biggest enemy, it's its own nature, that you can actually create. There's only 21 million Bitcoins. You could create 21 million cryptos, out of thin air.
Mm,
But look, there's people that are way smarter than me that blindly believe in it, and they've been doing very well, and I'm glad for that. But I just feel that I think there's a lot of considerations as well, and I just call for caution. So, like everything,
yeah.
it probably has a role to play, but it's like gold. It has to be in the right size and right amount, and yeah, I think so. Does real estate and many other things. So yeah, I think that movie, we'll see how it plays out in history. But ultimately, technology. I'm a huge fan of technology, and there's a big problem to solve, and this is an effort in that direction. I'm skeptical around many of the things around it, and the alchemy of creating money out of thin air, and that wealth effect is very virtuous on the way up, but it's extraordinarily vicious on the way down. And yeah, I'm just when I see, as I said, the Melania coin and things like that.
Mhm.
Uh, I think it's the rationale for those things, and who's getting rich, and is there any real value creation. I can't help but being extraordinarily skeptical, and I just don't think that movie is going to end up well. But anyway, just play with caution.
Yeah, yeah, exactly. And I sort of love the concept of there, being some real innovation there, but it's early innings, right? This is very new, and so with that comes a lot of Wild West behavior that you have to really be careful about. But it's an education for all of us. I think we're all on that learning journey. Diego, it was so wonderful to catch up with you. I think that we're just at the beginning of this sort of new era. And so it's such an important conversation to have about what real diversification looks like. I think we're all taking a hard look at our portfolios and trying to figure out a way forward. So really appreciate you coming on and sharing your views since you've been thinking about this for such a long time. So thank you.
It's my absolute pleasure. Thank you so much, and look forward to continuing the discussion anytime. Thank you, Maggie and team.
Same here.
Thank you.